Good afternoon, everyone. We have just a few minutes before we get started. While you're waiting, you can go ahead and connect your audio. You can listen through the phone or through the computer, whichever you prefer. We do have a handout that's available for you in the Handouts pod. You can click on that and then click Download, and we will get started in just a few minutes. And that's all from me. I will go ahead and turn it over to you, Sarah.
Great. Good morning, everyone. Thank you very much for joining us today. We're excited to be back talking about the Tax Cuts and Jobs Act. We were hopeful we'd have a lot more guidance from the IRS to talk about right now, some more specificity, but that has not all been released. And so we're going to give you an overview of the elements of the Compensation and Benefits Act, provisions that were in the Tax Cuts and Jobs Act, and talk about how those are impacting businesses, employers, and individuals going forward. We'll also throw in a couple of other areas that are still relevant. They may have been some other legislation or other provisions that came out earlier in 2017 or early here in 2018. Joining me today, as you can see, we have our usual disclaimers and information. Joining me today is Deb Walker. She is our National Director of Compensation and Benefits Planning for Tax, and she will be leading our discussion. We hope that you will get a better understanding about some of the more disturbing or complicated areas that are in this new rule, meals and entertainment expenses that are now no longer deductible, commuting expenses that are no longer deductible or some that are now subject to tax to the individuals receiving those benefits, raise some awareness of our new FMLA tax credit, the Family Medical Leave Act credit that's available just for a short time, but could be extraordinarily beneficial to certain employers who are already have provisions that would allow them to take advantage of this credit. And finally, look at a couple of areas for tax deferral of income on benefits from certain equity plans, and these are for private companies. So we're going to talk, as you can see on our agenda, covering a lot of areas, and we've got quite a program, so let's go ahead and get started. And Deb, let's talk about some of the key changes that happened with employers in dealing with compensation.
Right, and thank you, Sarah. This is one of the very exciting pieces of this legislation. It is only for private companies, and it is a way that Congress is enabling private companies to attract workers that they need, even when they don't have cash to help with cash for compensation or as much cash for compensation, certainly as some of the more established high-tech companies have. It's a new type of tax, so it's unusual, but basically it applies to option exercises and restricted stock units, not the transfer of restricted stock, but a restricted stock unit. And the income is determined when the option is exercised or when the restricted stock unit is paid, but the tax on that amount is deferred for up to 5 years to when the stock is no longer transferable. So again, this is a way that people can be paid compensation, and yet the cash needed to pay the taxes is deferred. So it eliminates cash flow issues. Unfortunately, as the slide notes, FICA and FUTA are still due at exercise, but as I say, income tax can be deferred for up to 5 years or until the date the stock becomes publicly traded. It is specifically designed for people that expect to be going through an IPO or something like that in the near future, and they'll have an infusion of cash. So who can get these options or restricted stock? Well, you cannot be a 1% owner in the current or preceding 10 years. You cannot be one of the 4 highest paid employees in the current or preceding 10 years. And you can't be a current or former CEO or CFO or spouse-dependent child, grandchild of those people. So what they're trying to do is help attract, provide small private companies with the ability to transfer equity to workers, but workers that aren't essentially the highest paid or the founders. Now, here's something that some people get upset about. At least 80% of qualified employees, not part-timers, but qualified employees, have to be granted options or restricted stock units. Now, this is something that shouldn't get people upset because they only have to be granted more than a de minimis amount. So the employer still has the opportunity to decide how many options people get or how many restricted stock units people get and can pay on performance. But 80% of qualified employees do have to get some kind of option. There are some other restrictions on these plans. You can't have made an 83B election. You have to elect this provision within 30 days after you vest. It can't be made if there's any stock that's publicly traded. Again, this is if there's, it's to open up markets more where you don't need cash. So if you've got publicly traded, you have enough cash you could go to the market for. You cannot have, the employees can't have the option to get cash when they exercise their option or settle their restricted stock units. And perhaps one of the most controversial ones is this notice requirement, because it's not, the employer has to give the notice to employees of this opportunity to defer cash tax for 5 years. Yet some people are concerned that they may fall into this provision when they don't really want it to apply. As I said, cash poor startups are who this is targeted to, somebody that anticipates an IPO or venture capital funding, which will give everybody cash and a market for the stock, so it could be sold for cash to pay the tax. And the other big point here is that 80% of the employees test only requires a de minimis number of shares. There's no non-discrimination rule, if you will. You just have to give a certain number of shares. And finally, what everyone is saying, if you are a private company and you have options or you have restricted stock units and you don't want this section to apply, then you need to make sure that your plan is drafted to avoid it. In other words, give some different rights and features in equity awards to different employees. That will violate the rules, and therefore you don't have to worry about the notice requirement. Now, that's the end of the good news in this little compensation section. What we have bad news for tax-exempt employers. Taxable employers for a long time have had their compensation deductions limited to certain compensation paid to certain people to $1 million unless it's performance-based compensation. Tax exempts haven't had that rule. Well, now tax exempts have an excise tax on excess parachute payments and remuneration over $1 million. So there's two different things that can happen here for a tax-exempt organization. If they pay remuneration over $1 million with respect to a covered employee, a tax applies, 21% excise tax applies. Also, if they pay what's called excess parachute payments. They call these things excess parachute payments because they're payments made at severance of employment. And that can be even less than $1 million. So let's talk for a minute as to who is an eligible tax-exempt organization, because those are the people that have to pay either the $1 million or severance pay that is in excess of the allowable severance pay amount. An eligible tax-exempt organization is an organization exempt from tax under 501A, so that includes all your 501 charities. It's also an entity with income that accrues to a state or political subdivision exempt from tax under 115. Now, it does not include all state and local governments. That, I think, was an error. State and local governments don't have their tax exempt under 115, but rather under the doctrine of governmental immunity. So 115 will exempt the tax for, say, a port authority, a public library, a hospital district that's owned by a city or county, but it doesn't apply to the city or county itself. So absent a technical correction, this provision doesn't apply to a state college or university which has not applied for 501c3 status. Of course, this brings up the issue because we have some states and colleges, state colleges and universities that apply for 501c3 status in addition to being a governmental entity. So can they give up their C3 status? Do they want to give up their C3 status? This is all questions that we don't really know the answer to. But right now, it doesn't apply to a state college or university. So some of those big state colleges paying football and basketball coaches a lot of money aren't affected by it, absent a technical correction we wrote on the slide. And I really expect to see an technical corrections. I don't think Congress meant to tax the private university that pays a lot for a football or basketball coach, but not tax the state or governmental college for doing that. Okay, so what is this excise tax? It has to be a covered employee, one of the 5 highest compensated employees for the taxable year, or any of the 5 highest compensated for any prior year beginning after 2016. So over time, we're going to see a lot more than 5 people get included into this provision, and you had to have earned at least $120,000. Remuneration, what you're looking at to see if in fact it's more than $1 million, is anything that's subject to income tax withholding, whether it's paid by the tax-exempt entity or maybe a related entity. It could even be a taxable entity. And then, of course, we have the provisions that apply to tax-exempts and government and educational institutions, the 457, which taxes amounts at vesting, 457F, and that will be included in remuneration also. Now, that's the $1 million. So pay more than $1 million to one of those 5 highest compensated, either in the current year or any prior year, the amount is subject to the excise tax. Then we have an excess parachute payment. Excess parachute payments are anything in excess of 1 times your base amount if the total parachute payments exceed 3 times the base amount. So the base amount is your average annual compensation over the prior 5 years. So what you do is you look back over your W-2 income for 5 years, you take the average of that amount, multiply it by 3, and see if the amounts paid on an employee's separation from service exceed that. If they do, this is a very unfair provision. So if you exceed 3 times, then in fact, everything in excess of 1 times the base amount is subject to the excise tax. For corporate America, these are the same rules as Code Section 280G rules. So that's why some of this language doesn't really make sense. But the bad news for tax-exempt organizations is that if an employee separates from service and gets retirement pay, or even some non-taxable amount, retiree health benefits, if it exceeds 3 times the average amount that he or she was paid over the prior 5 years, then there's a 21% excise tax, and this may go way below the $1 million. So let's move on to the changes in 162M. This is the $1 million cap, but this applies to public companies, and this has been expanded. It's going to affect a lot more companies than it did before. First of all, because they broaden the definition of what is a publicly held corporation to include corporations just with privately held debt, not privately held equity. And the biggest thing that Congress did was eliminate what's called the performance pay and commission pay exceptions. Now, the $1 million cap applied to remunerations paid to a covered employee, and but it didn't apply if the compensation was what we call performance pay. In other words, if the amount of money somebody was getting was based on certain performance objectives that were set out and approved and certified by the compensation committee. In addition, it didn't apply to stock options or stock appreciation rights because by definition they were performance pay because the stock was going up in value to have any payment to these individuals. They eliminated performance pay. Now it's all subject to the $1 million cap, and they expanded the definition to include CEO, CFO, and the 3 highest paid employees, and any person who's been in that role for any year after 2017. So again, we're going to see lots and lots of people that expand into this space where the amounts are going to be non-deductible for the public company.
All right, that brings us up to our first attendance check. This is our first polling question number 1. So if you'll make sure you open up the poll on the gray bar. And key to applying Section 4960 and Section 162M is first identifying what kind of employees. A, retired, B, part-time, C, full-time, or D, covered employees. I'll give you just a minute to pick an answer there. All right, the answer is D. Identifying all covered employees is going to be very critical to applying these code sections and these limitations. Limitation on deduction under 162M and the excise tax payment for similar types of compensation to tax-exempt organizations under Section 4960. Okay,
so
Deb, talk about this change.
A covered employee can be all of those things. Full-time, yes. Part-time, retired. Putting those retired people in there as covered employees, that's a new change this year, and it's a big expansion. Okay, real quickly, we have supplemental wage withholding was decreased. Well, supplemental wages are bonuses, stock option exercises, anything you get out of the ordinary salary. And in fact, it's taxed at a supplemental rate. Used to be 25%. Now it's dropped to 22% with the decrease in the individual income tax rates. And if it's more than $1 million, it's dropped from 39.6% to 37%. It's a mandatory withholding on the 37%. You can use the tables or a W-4 on the 22%. And the Employee Retention Credit, we had a little technical correction in the 2018 Bipartisan Act, which is that to the extent you've paid, you're in a qualified disaster area, you operate an active trade or business, and you can claim a credit for 40% of wages paid to employees up to $6,000, even if your business is inoperable. Of course, you have to keep paying your employees, so the government's going to fund 40% of that. But the deduction that you would get for wages paid is reduced by the amount of the credit.
So this really came in most recently with the hurricanes last August and September. But seeing the storms we've had on the East Coast, it brings to mind that if employers did not take advantage of this and have not filed their 2017 returns, they really should take a look at this credit.
Okay, let's move on to
step into fringe benefits.
Sorry. Qualified transportation fringes. This is a very controversial area and kind of an eye-opener for some people. First important point is amounts paid after 2017. That's amounts paid today, yesterday, last month. Anything after 2017, there is no deduction allowed for an employer for the cost of commuter vans and shuttles, transit passing, qualified parking, or sometimes you have commuter vehicles that go around and pick up employees, any transportation between a place of residence and work. It could be for benefits that are either taxable to the employee or tax-free. So it's sort of a double whammy. It's going to be something's going to be taxable to an employee and no deduction to the employer. And it includes the cost of administering the benefit. So we do have one, I think this is Sarah's favorite one. Bicycle commuting expenses are no longer tax-free, but they can be deducted. So this is everything other than bicycle commuting expenses. So now, how the deduction is based on the cost. This is why it's kind of hard to kind of wrap your head around this. The employer's deduction disallowance is based on the cost, but the employee's income exclusion is based on the fair market value. So some people thought that, oh, if we do pre-tax salary reduction for qualified transportation fringes, the employer doesn't have any cost, we don't have a disallowed deduction. Well, that's not the case. Pre-tax salary reduction converts what would otherwise be compensation into transportation expenses and results in a disallowed deduction. Post-tax salary reduction is deductible compensation. Therefore, to avoid this, some people are making salary reduction post-tax, salary reduction payments for qualified transportation post-tax to avoid the disallowance of deduction at the employer level. Again, it can affect your tax return for a fiscal year ending in 2018 because it applies to any expense incurred after 2017.
All right, let's talk about a couple of examples. As a matter of fact, we've had a question come in about parking and paying to someone, and so let me tell you, we'll walk through these examples, and I think we'll address the question. So first case, we've got a law firm that employer, and they lease 25 spaces in a city garage for their employees to park free during the weekdays. The city's monthly rate for parking in the garage is $100 per slot. So Deb, what's the employer going to do with that $100 payment for each of those 25 slots?
So this is a pretty straightforward example, and I think everybody would say the $100 times 25 per month is going to be a disallowed deduction for the employer. The amount still would be non-taxable to the employee, but non-deductible to the employer.
All right. Cool. Here's another example, a little more opaque. We've got a retail store employer that requests their employees park in the shopping center parking lot a little further away from the door, about 10 spaces from the door to leave room for customers and shoppers. There's no charge for anyone at all to park in this open parking lot. The employer does pay a monthly common area maintenance fee, that CAM fee, to its landlord, and that's for maintenance of the whole shopping center and for maintenance of the parking lot. So how do we think here? This parking lot is open to anybody.
Yeah, so a lot of people are arguing that there should be no disallowed deduction for this because it's not a qualified transportation fringe. It doesn't have any value because anybody can park there, and IRS has not said that's the case, and in fact, the Joint Committee has said it's not the case. So in this case, I think the answer is going to be that the employer has to figure out whatever the monthly CAM fee that's for the maintenance of the parking lot, and there might be also some leasing cost for the parking lot too. I'm not sure how it's set, but it's an allocated cost paid by the employer for however many of their employees' spaces are used, and it's just all allocated cost. Unfortunately, I don't think the fact that it's zero value is going to help us out of that, but it could. We really do need guidance.
All right, our final example is similar. We've got another law firm employer, and they're allowed 25 spaces in the private garage owned by the landlord, and the cost is included and not separately stated in the office space lease. So it just is part of the lease. They're signing for their office space and paying monthly rent for. It also says they're allowed 25 spaces in the garage attached to the building. So again, it sounds like how would this get treated?
Well, this brings up two things. Is probably this space is used primarily for employees, but of course the law firm does have clients come to visit sometime. That doesn't matter. It's the same situation as the shopping center. And then we have a lease cost that some portion has to be allocated to the parking spaces that the law firm is leasing from the landlord. Again, the problem the Treasury is going to have when they're trying to write the guidance here, because we really do need guidance, is how do you differentiate between a shopping center where it's free to everybody and a garage behind the office building where basically the only people that use it are employees and maybe a few customers or clients or something. But yes, I think the lease costs have to be allocated. So the committee reports make it pretty clear that it's the non-deductible costs are broad. It's maintenance, snow removal, depreciation, lease expenses, payroll costs if you're administering a transit program, and we do really need guidance in order to know exactly how broad. I expect these bullets to all be included. But the more important one is, what if the fair market value of the parking space really is zero because anybody can park for free? We have an old notice we showed on the slide, 94-3. 94-3 says that the value of the parking is based on its cost, but that if it's not determinable what that is, such as in the shopping center, then an individual, it's whatever the individual would incur in an arm's length transaction to park in the same lot. So in both the shopping center and the law firm example, an individual incurred zero to park in the same lot. And so what we're hoping, of course, is that IRS will say, if that's the case, there is no qualified transportation fringe. There is no value to be excluded, and there is no disallowed cost. But we definitely need to wait for guidance on that. The tricky part here, again, couldn't leave out the tax exempts. So in this case, we have unrelated business taxable income that is imposed. Again, it's a little bit hard to get your head around this. This is a tax on an expense. It's not a tax on income. So it's a tax on a qualified transportation fringe, a parking facility used in connection with qualified parking, and an on-premises athletic facility, unless that gym is available to all employees. So tax exempts now are going to have unrelated business taxable income, and in fact, they might not have ever had to file a 990T before, but now they will end up having to file a 990T to tax the amount of these qualified transportation fringes. What I've seen a lot of colleges and universities do is convert their pre-tax salary reduction for qualified transportation fringes into post-tax salary reduction to avoid the need for having to file a 990T. While we're in 2018, you could convert what had been previously pre-tax salary reduction into post-tax salary reduction. As I say, because this applies to expenses incurred over the past 5 months since January 1, 2018.
So that in both situations where the expense is disallowed, or for the tax-exempt organizations where the expense is reported as a taxable income item, if the employee is paying for it out of their post-tax salary, then the employer does not have to concern themselves with it, is our
correct.
best guess. Okay.
That's correct. Yeah.
Oh, all right. Well, we have that in our mind. Parking provided to employees, we're at attendance check number 2, so please check your polls there. Parking provided to employees must be evaluated to determine if it is a qualified transportation, what kind of benefit, a health benefit, a social benefit, a fringe benefit, or a life benefit. We'll just give you a moment there to answer that question to make sure that you get your CPE credit. So a lot more record keeping is going to have to go on to make these determinations and allocate and find those non-deductible items or the items that need to be reported as taxable income for tax exempts. All right, Deb, let's move on to meals and entertainment. The answer to that question is fringe benefit. It's a qualified transportation fringe benefit. Got a couple more things here. Moving expenses. This is another fringe benefit that was impacted. As a matter of fact, is now non-deductible by the employer and taxable to the individual. It used to be that you could get a certain amount of funding to pay for the cost of moving yourself and your goods to a new location, to a new home, and that could be deducted by the employer and would be non-taxable to the individual. That is no longer the case unless we're talking about an active duty military personnel move pursuant to a military order. So because of this, employers are evaluating the impact of this law change and looking at their relocation programs, and maybe considering going to just a lump payment to individuals, taxable income, and even considering whether or not to continue to gross up those payments and pay the tax as well, or how they're going to handle those. So if you have moving expenses and relocation programs, as an employer, you may want to revisit this. And if you are in 2018 anticipating a move, or were reimbursed for a move, you can go ahead and consider that that is going to be additional income to those individual employees. The home disposal programs, as outlined in those two revenue rulings that are situated there, are not affected by this change to the moving expenses. Those are a separate set of rules and guidelines, and they are not part of the moving expense. One other fringe benefit to talk about, that's employee achievement awards for length of service and safety awards. As long as the cost doesn't exceed $400, it's still deductible by the employer and non-taxable to the employee. But again, we're talking about nothing that in the form of cash or value that could be created. You can give away tangible goods or certificates for a selection of tangible goods, but no more gift certificates, cash, checks, and awards, tickets to events, stocks or bonds or other securities. It has to be some sort of tangible good or to award the employee for that. Okay, let's move on to meals and entertainment.
Okay, entertainment expenses. This old law, which allows or provides that there's no deduction for ordinary and necessary expenses, except those that are directly related to or directly precede or follow a substantial and bona fide business discussion associated with the active conduct of a trade or business. That's the rule that's been in place since 1978. There's lots and lots of, or it's actually 76, but the regs came out in 78. And those regs are very detailed, and everyone reads through the 3 or 4 pages of regs and goes, well, I'm sure mine's associated with or directly related, and let's just move on. So I would say that it was universally not very well applied, and agents would go in and even they couldn't go through the regs. They would basically say, okay, the trip to the Super Bowl is disallowed, everything else we're not going to worry about. And meals were treated as a subset of those and subject to the directly related to or associated with, but I think most business meals, unless you were at the Super Bowl, were considered non-entertainment expenses and still deductible. So now what did Congress do? Congress came in and took out the exception. And therefore, there's no deduction for entertainment expenses. And now we're going to spend a lot of time defining what is entertainment, specifically when you get to meals, because since the mid-90s, where there's been a 50% disallowance for business meals and a 50% disallowance for entertainment, it hasn't made any difference whether a meal was entertainment or not. So what do we know that for sure is entertainment? I would say that many, but not all expenses for entertainment are no longer deductible. So what is deductible? Okay, a picnic for your employees, a Christmas party for your employees, things such as that don't fall within this entertainment provision. Clearly, sports tickets, stadium license fees, private boxes, greens fees, event rental, musician, server, spa day, fishing, sightseeing, all of that stuff is entertainment expenses, no longer deductible. And of course, the transportation to and from that space. Now we get to the controversial part.
Yeah, so the transportation, that applies to folks who have airplanes that are companies that have aircraft that are flying to these entertainment type events as well. And
commercial tickets that people buy to go to the entertainment event. So commercial flights it applies to. And it applies to, in my mind, to all the meals that are consumed at these places or associated with these places. That maybe remains to be seen, but I think I can't imagine Treasury will come out with anything other than that. But what about a business meal? So, the example would be something is you're going to go to lunch with a client and the client is explaining tax information or you're planning an audit or something, and it's completely business. Surely that should still be deductible. Well, I think it should be. It's not clear whether it is or not. Another example would be, what if it's not a current client but a prospective client? And the way I think about it is anything with a current client, a prospective client, any of that where you're discussing business and you're not then going to play golf or then going to a sport event or then going to the theater, or the meal isn't after those events, that's going to still continue to be 50% deductible. Now, the other thing that although it'll be good to have guidance on that because it's not at all clear under the statute, but that's the position I would take. Now, the next one is that only 50% of the meals provided to the convenience of the employer and the expenses of a company cafeteria are deductible. That includes food and beverages furnished on the employer taxpayer's business premises. So the coffee that you got this morning from the break room, clearly the coffee is now 50% deductible instead of 100% deductible. What about the coffee mug that you drank it in? What about the machine that made the coffee? What about the plastic spoon that you used to stir the coffee? What about the dishwashing soap that washed the coffee cup? So this goes into just micromanaging of all sorts of expenses, which is going to be, we need guidance on how far is it the definition of a food and beverage. And I think employers are going to have to start rearranging their general ledger system just a little bit, because my guess is that the coffee or the cups or the plastic knives and forks may be in office supplies as opposed to food or beverage. That's the kind of stuff. And it's beginning in 2018. That means the stuff you drank yesterday or the day before or last month. Meals for the convenience of the employer and company cafeterias are non-deductible beginning in 2026. It was pretty clear to me that people were complaining that you couldn't shut down company cafeterias so quickly that employers needed time to adjust. And so 50% deductible for the next 10 years and then non-deductible totally unless the law is changed. So now we want to go through the guidance a little bit, Sarah, here.
Right. So what do we know so far? What is out there already? Because we have these really, really complex sets of rules to follow that have just been changed by ripping out certain sections that we had all gotten used to. So the Joint Committee report for the Tax Cuts and Jobs Act, just to be clear, gives only one example of a meal that is still eligible that is not an entertainment. It says that meals consumed by employees on work travel, those are still good deductible business meals, 50% deductible. That is the only example given. Now, that doesn't mean that's the only one. It said, for example. So clearly there are other business meals which are deductible. We just don't have any other concrete examples such as this to rely on. Section 274K says a business meal requires that the taxpayer or his agent is present. So if you don't have an employee present, the owner of the business, or have an employee present, that's clearly going to be an entertainment type meal because you haven't got an employee that is in effect making that a business meal. So it may still be required, but if the employer is not there, or an employee is not there, you're going to have a hard time saying that's a business meal at all, subject to the 50% disallowance. The former standards we used to rely on are directly related to business or associated with business or no longer available to us. So we lost that element that we could of history that we could rely on. And finally, IRS Publication 463. Now this has not been updated for the new law, but they have clearly stated in that publication that entertainment includes the cost of a meal you provide to a customer or client, whether the meal is part of other entertainment or by itself, and a meal expense includes all the expected costs. So at least in the IRS publication, they're saying, look, a meal can be entertainment even if you're taking a customer out or a client. We have really sought better guidance and better information on that. And Deb, as a matter of fact, that seems, we hope that when the IRS goes through and updates this publication, they'll give us some better parameters around that use of the term entertainment in that context. But Deb, talk about what the AICPA has done.
Well, the AICPA and others, but the AICPA has written a letter saying that business meals should not be disallowed, and laid out some specific examples: a business owner, an employee, and a current or prospective client, and also other professionals that you talk to. It can't be lavish or extravagant, that's clear. And then what is the definition of lavish or extravagant? And then we have to have some reasonable expectation of deriving some kind of income or other specific trade or business benefit from the encounter. Of course, the AICPA is pushing for guidance. A lot of people are pushing for guidance. And just a little bit on that, Treasury and IRS have, created an office of to implement the tax law. There are 400 forms, instructions, and publications that need to be modified as a result of the changes. They've already gone through, and most of the 2018, if not all of the 2018 forms have been created or revised. I think they had to create 8 new forms for the tax law. In addition, they've almost done all of the instructions. All of that stuff is going to be released to the public during the summer. And we will also see publications that get revised as we get into the fall. They have said that a lot of the changes affect individuals, and individuals get their information from instructions and publications. So they're starting there with making the changes. And so there will be some new law created, if you will, in these IRS publications, which I think is something we're not quite used to, although it makes sense in the digital world in which we live today. The last thing I'll mention is the Joint Committee has said clearly that business meals are deductible. They're going to put it in the Joint Committee, what they call the Blue Book. The Joint Committee of Taxation releases an explanation of the law that was passed. And they've said that they'll put that in the Blue Book, but we have to wait till the Blue Book's out to really know, and we expect that to be out sometime this fall. Treasury, on the other hand, says the Blue Book is not legislative history, and we're going to read the statute, and we're going to decide what we're going to do because it's our job, not yours. So we see a little conflict between the two staffs there on the Hill and on the administration.
All right, so sort of in summary, let's kind of walk through, in summary, we've got employee travel meals and in-office meals. Those are still 50% deductible. That seems to tick all the boxes. You're working, clearly that's associated with your business. Entertainment meals and meals without employees, that seems to be completely out, 100% non-deductible. And where those other areas are, employee meals with clients and customers and vendors actively discussing business, it's uncertain but likely to be deductible. And also when you're talking about employee meals or owner meals with non-clients, targets, prospects, that seems to be, that it too is uncertain but likely to be deductible. So that's, we're still on the 2 uncertain but likely deductible. That is the best information we have at the moment. We don't have guidance. As you can see, the ABA, the AICPA, other trade associations have all asked for clear guidance on this issue and other issues related to meals and entertainment. So Deb, before we leave this, we've got a couple of questions if I could pose to you. So let me back up to the transportation. We have a company that is providing commuter services, or providing transportation services between business locations. So you have a doctor working at one hospital and is transported by the employer to another hospital so that they do not lose time driving themselves, but providing that between one work location and another location. That's not the kind of transportation fringe benefits that this law is addressing.
Yeah, qualified transportation fringes are for commuting. Commuting is going from your residence to your first place of work, which is your normal work location. So I go from one office to another office. That is deductible transportation expenses. It's not, and it's excludable for me as an individual employee, but it's not commuting expenses. These disallow deductions for commuting expenses.
Great. So we had another question about some examples of meals that are considered a form of entertainment. One might talk about, say, having a hot dog or hamburger at the golf club, maybe even at the turn at the night toll. You could also talk about, another question came in here, what about for someone giving a customer a gift certificate for a meal at a local restaurant, which the company, the employer or the employee would not be attending. They're providing that gift certificate to their customer. Now, maybe that's a business gift, but maybe that's also a meal and 100% non-deductible. If it can only be redeemed for food and beverage, perhaps that meets this criteria of an entertainment meal that is there. But an in-office meeting, if you have your client in the office to meet in your conference room over lunch, or you do a lunch and learn type meeting, then those all, and with the food brought into your office, that seems to meet the criteria of 50% deductible. It's once you walk out the office door that brings in the level of uncertainty. Wow, that's a lot and very complex. So with that, our attendance check number 3, taxpayers should begin tracking costs for A, employee travel meals, B, employee meals with customers and vendors, C, entertainment meals, or D, all of the above. I'll give you just
I think
another
with your last example, Sarah, it's clearly non-deductible if it's on the golf course or before you're playing golf. And the gift certificate could be, if you're not going to present and you're giving it to a customer, it could be a purchase price adjustment. So it's interesting. That one is a very tricky one.
All right. So all of the above. As you can see, it used to be we could just put everything into one account, meals and entertainment, and not worry about it. Now, unfortunately, we're going to need to start breaking those out a little bit further. So, Deb, let's move into retirement plans and talk about some of the changes that have gone on here in our last 10 minutes or so.
Okay, so this is hardship distribution from a qualified retirement plan. The general rule is you can get money from a 401k plan or another qualified 401k plan, another qualified retirement plan for hardship if it meets an immediate and heavy financial need and doesn't exceed the amount for that need. There were some restrictive rules in the regulations that said you had to stay out of your 401k plan for 6 months. Congress is directing IRS to change that rule and get it out of the regulations, so we'll see that in a year or so. Also, hardship distributions could only be made from elective contributions and certain matching contributions and certain employer contributions. Congress has expanded the types of contributions into a qualified retirement plan that can be used for hardship distributions. And you're no longer required to take a loan from the plan. These last two are effective beginning in 2019. They don't take regulatory changes. The next one is on retirement plan loans. We have some plan loans with extra time to repay. The problem often happened that somebody terminated employment and they had a loan from the employer's retirement plan. So they got a distribution from the plan, but of course when the loan was distributed from the plan, they had taxable income but no cash. They'd already gotten the cash before. Now they just didn't have to pay back the loan. So what and it was taxable, and they only had 60 days to roll it over. Of course, they'd have to take cash from another source to do a rollover, but it would avoid taxable income. So what Congress said is these people don't really understand the 60-day rule for rollovers, so we're going to let them have until the due date of their tax return. Hopefully their preparer will tell them, oh, to avoid taxable income on this, if you roll over your amount contributed to an IRA, then you can avoid the taxable loan, and so that's very favorable. The other one is, the next two are for qualified disaster areas. You can get loans up to $100,000 or 100% of your account balance. That goes to the limits that are in the statute for non-taxable loans, and the loan repayment can go from extended for a year. Usually they're 5 years. This would make it into 6 years. Next one, qualified disaster distributions, is exciting for people that live in disaster areas. You can get distributions of up to $100,000 as a qualified disaster distribution from qualified plans. You have to have had a main home in the disaster area, and the main home has to have sustained a loss. The distribution doesn't have to have any be used to repair the house. It doesn't have to relate to the amount that the damage was. So if you have $5,000 distribution damage to your home, but you took a $50,000 retirement plan distribution, this still applies to you. The amounts are included in income over 3 years, not subject to an additional 10% tax if you happen to be less than 59.5. And other than required minimum distributions, you can roll those distributions over to avoid the taxable income. So qualified disaster distributions could be spread over 3 years and maybe not taxed at all and contributed back to the IRA within 3 years. The next one is the recharacterization of traditional IRA and Roth contributions. This is what would happen is that people that could not contribute to a Roth IRA because their adjusted gross income was too high, they would contribute after-tax amounts to an IRA. Then they would take that after-tax amount and convert it into an IRA, into a Roth IRA. And thereby they would never have to pay tax on the earnings on those amounts. If it would stayed in a traditional IRA with an after-tax contribution, then you would have earnings taxed when the amount was distributed. Now, what would happen is sometimes the market would go down. You can tell this was something that happened a long time ago, but at the time of the conversion. And so people would wish that they had not converted to a Roth. And this just let them recharacterize. I put it into an after-tax. I converted it to a Roth. I can take it back out of the Roth and put it into an after-tax and get it over to the Roth later. It's a very small change. I'm surprised they didn't do more, but it is what it is. And last one, of course, at the very end, they eliminated the individual mandate from ACA. So the penalty tax that applies to individuals who don't have health insurance of minimum essential coverage beginning after 2018 won't have to pay any penalty tax. The employer mandate continues to apply, and all of this is based on what the employer is reported. We've seen a lot of people getting proposed assessments for 2015, and that's based on the filings that the individuals made in 95, and this is going to continue. This tax bill did not change the employer mandate at all.
All right, as folks we have our next attendance check number. Recharacterization allowed a taxpayer to reverse, inherit, spend, or donate a Roth IRA conversion if the value of the Roth fell before the return was due. So while folks are answering that, Deb, could you just help us a clarification on when someone takes a hardship distribution out of their retirement plan, can they still continue to make contributions into that, or must the contributions be suspended for a 6-month period?
So the regulations right now require the contributions to be suspended for 6 months. Once the regulations are changed, then they won't have to be suspended. So we have to wait for regulatory changes.
Yeah. Okay.
The new law directs IRS to change the regulations. Once those regulations are changed, there'll be no more suspension.
Great. All right, our attendance check word answer number 4 is reverse a Roth IRA. All right, in the last minute or two, just give us the quick highlights about this, the Family Medical Leave Act tax credit.
Yeah, this is a big tax credit, but it's only available for 2 years. So the employer can claim up 12.5% or maybe even 25% as a tax of wages paid as a tax credit for 2018 and 19 to individuals that are on family or medical leave. It's not available for leave payments required by the state and local government. You have to have paid the qualifying employee, or you can pay the qualifying employee for up to 12 weeks. You have to pay them for at least 2 weeks, I think. This shows you how the credit increases to the extent you pay more than 25%, more than 50% of normal wages. And the credit, again, like the retention credit, reduces deductible wages. So the biggest thing, the credit is large. It has to be for wages paid because of the birth of a child, care for a spouse, a child or parent, a health condition of the employee unable to perform their job, care for a service member, care for employee's spouse. And the question we've gotten here, and a lot of people are looking at this credit because it is so large. If you give PTO for people that are sick or sick leave or require people to take PTO for the birth of a child, that's not eligible for the credit. It has to be credit, it has to be payments that are separate from your PTO, vacation, or other program, specifically for family medical leave. Although the other question we've gotten is, well, do I have to pay for all of these things, serious health conditions, birth of children, all of that stuff? Because some employers only pay for birth of a child. And in fact, most people think that it doesn't have to be for all of those things, although we don't yet have guidance from the IRS. We do have some FAQs that have come out, which is why we know that vacation pay and PTO that are used for birth of a child or a serious health condition, sick leave, can't be used. So who is a qualifying employee whose wages you can pay that will get this credit? It has to be somebody who is employed for at least a year and has earned no more than $72,000. So it's really designed to encourage you to pay family medical and leave wages for people that make $72,000 or less. An eligible employee, there has to be an employer. They have to have a written policy to do this. You have to pay expenses at least 50% of their normal wages, and so 50% up to 100% is how it would go from 12.5% credit up to 25% credit. You will have to allow full-time employees at least 2 weeks of leave, and you have to provide part-time employees a prorated benefit. So if somebody works 20 hours a week, you're going to have to give them 1 week of leave. And with that,
this is an income tax credit, not a payroll tax credit.
That's right. It's a general business credit, like all the other general business credits that we have. So the deduction for these wages is disallowed if you claim by the amount of the credit.
All right. Well, as we wrap up, just a couple of thoughts on things you can do now. One is to walk through your benefits program and see if any of these tax changes may apply to your current benefits for employees, because it's pretty broad reaching, touching on many fringe benefits here. Think about your record keeping for meals and entertainment expenses and for costs for employee parking and other transportation fringe benefits. We're going to need to identify those costs when filing your tax returns and separating out those that are non-deductible. Consider if the credit here or if those retirement plan changes we talked about at the very beginning for private companies can apply. And also, if you're one of our tax-exempt organization employers, there's some pretty onerous penalties out there, and we need to be planning around those. And finally, as Deb has mentioned several times, all this is effective here in 2018. So even if you're on a fiscal year end, What's happened between January 1 and today is impacted by these changes. So thinking about those that have June 15 estimated tax payments, how important are these items to your tax payments? So again, we thank you very much for joining us today. And if you have any questions at all, please reach out to us. I think we've tried to answer those that have come in through our question pod. We thank you very much for those. But if you have additional questions or we didn't answer yours, please reach out to us and we'd be happy to talk with you. So thank you and have a very good day.